Good morning, everybody, and welcome to the Daily Energy Market Podcast. It is the 8th of October, and we have Brent crude oil coming off a bit this morning in early trade in Asia. Brent is down 2% at under $80 a barrel, 79.37 after closing yesterday above $80 a barrel for the first time in a while. And We have perhaps some profit taking. We'll have to sort of see what the view is. But let's kick off this morning with Neil Atkinson, former head of oil markets division at the IEA. Neil, clearly it's been a dramatic week. A week ago, actually, we were having our forum in Fujairah Tuesday. The speeches by the main speech that day was the Gunvor chairman, who made a big point of saying that he didn't believe that geopolitical stress would threaten oil supplies. A week later, we've had oil prices jump 10%, and they still haven't threatened oil supply. So maybe the Gunvor chairman is still right, although a few hours after he spoke, Iran struck Israel. Your thoughts of where this market is taking direction from at this point, looking out from the $80 a barrel?
Well, I agree with Gunvor. I've always been a skeptic that the Middle East conflict would intensify to such an extent that we would see an interruption to energy supplies from the region. And that's because the region is just far, far too important for a lot of people. And of course, a lot of the increase in prices we've seen in recent days follows on from the statement by President Biden at the end of last week. I wrote down the quote where he said, "I'd be thinking about other alternatives than striking oil fields in respect to what Israel might do." The very fact that he used the words oil fields in a statement obviously was very influential. But, Iran is the main supplier. Sorry, Iran's biggest customer for its oil is China. And the idea that there could be any interruption of regular supplies to China is, I think, very hard to conceive of. You read that, well, China could get oil from somewhere else. But of course, if there were to be a really intensive build-up in the Middle East, which led to supplies, they wouldn't be able to get much more oil from Saudi Arabia, Kuwait, Qatar, Abu Dhabi, and anybody else. And of course, Saudi Arabia would find it very difficult to export oil through the Gulf, but also in the Red Sea because of the Houthi attacks on tankers. There would be stress there, the Houthis being supported by Iran. But I don't think it's going to get that far because there is too much at stake. The economic damage caused by an actual interruption in supplies is too dreadful to contemplate. So, of course, the markets look at escalation as a risk. Obviously, I mean, it's ridiculous to say there is no risk. But I think the Gunvor chairman is absolutely right that there is too much at stake, and the risk to actual supplies is something that still remains a low risk.
Peter McGuire, CEO of XM Australia. Peter, meanwhile, in the background, behind all of this geopolitical noise, China offered a fairly substantial stimulus to the markets 2 weeks ago. It had another sort of introduction or announcements today. Equity markets have rallied quite strongly in recent weeks. Has China's announcement and its rally had anything to do with this 10% climb in oil prices in the last week, or is it all geopolitics? Your thoughts on the intersection of China's role into uplifting oil markets?
Well, Sean, and good morning, good afternoon from Sydney. Lovely to be here. I think there's so many different moving parts when you look at the China situation and what we've experienced in the last 2 weeks. As you know, they were on holidays for the best part of a week. I'm just noticing the CSI 300 is up 4% today, but you've got Hong Kong down 7%, and some markets in Hong Kong down 9% for the day. So I think that the actual uplift as far as Chinese equities is going to be maintained for pretty much the rest of the next couple of weeks. Let's see how it rolls into November. But at the moment, it's a lot of hot talk and there's a lot of hot action and people following the market. As far as demand pitch is concerned, they want to re-engage China naturally and just get all the engines moving in synchronicity. And at the moment, well, in the past, it's been fairly fractured. And this has got to be interpreted from not only funds flowing into China, but the domestic engine has got to really start to be engaged, and from the property sector all the way through to manufacturing, and the end user has got to be consumption internally. You can't argue with the numbers. Some of these markets, Sean, are up between 25 and 43% for the month. And that is just quite extraordinary. I don't think I've ever seen a stock market up 40, or any index up 40% in a month. And that's what's been achieved in China. So it's dramatic uplift, and maybe it's going to be a continuation for up until, December 31, but I think that could be a bit of a stretch.
Let's welcome Genevieve Shah, Vice President, Oil Markets, Cross Barrel Balances Lead in Rystad Energy. Genevieve, your thoughts of maybe bringing some sort of fundamentals to this sort of market that is being distracted by obviously the geopolitical risk that's currently loitering, the China policies that have been introduced. They've electrified the equity markets there. We're not sure if that's going to translate into demand. Where is the balances at the moment in terms of the fundamentals of this oil market? And they were quite weak. We could see a week plus ago when we were struggling to get away from 70. Where is that picture at now?
Well, yeah, good morning, good afternoon, good evening. Thanks for having me on. Great to be back. From a fundamentals basis perspective, the market from a pricing angle has been fairly range bound. It's this added geopolitical risk premium on top in the recent week or so, which has added a significant amount, and topping 80 last night, and then some minor sell-offs earlier this morning within the Asian trading window. From a fundamentals though perspective, there is more than ample crude availability. There's the amount of spare capacity within the market, especially OPEC plus nations, is something that is really putting some pressure within the market. The crude side of the equation remains fairly oversupplied, hence why OPEC plus had to extend the cuts until December 1st. And as of the back end of this year, we are looking at, as of the current directive, the extension of cuts is not to happen. But our view here is that the extension will roll over because of the global oversupply of crude. Now, from a refining standpoint, we're now entering the turnaround season. We're definitely well into the turnaround season for the Atlantic Basin. We've come off the summer peaks within the US and all of Europe, because product demand, driving season and holidays have now surpassed. That period is over. So there's not real impetus for refineries to run as hard. And of course, this is the shoulder season from a runs perspective. So all of that put together, the market is looking fairly, oversupplied from a crude perspective. And then you consider what's happening across the demand side of the equation, where the Chinese demand, and we've seen this over the recent months, hasn't kicked as hard as most people within the market had forecast. The back end of last year, start of this year, when we're looking at the 5% GDP growth targets. So all of that put together, range-bound market from a pricing perspective, products fairly well maintained for the moment within regional deficits and surpluses. But the crude market definitely oversupplied, and hence our reason for OPEC plus to extend their cuts beyond December.
Neil, just looking at the current picture of the last week, obviously a big jump in the oil price, 10+% over that period, based on the bedded in expectation that the Israelis are going to retaliate against the Iranian strike last Tuesday night. Your thoughts on that? Is that priced into the market now? And is it priced in that they would strike oil infrastructure? Because 10% doesn't look to me like that's a lot when you consider what's at stake here. They've priced it in, but perhaps not priced in striking oil infrastructure. Your thoughts on how much this geopolitical premium of close to $10 in the last week, what it is representing from a market point of view?
Well, you could take the view that if participants really seriously believe that there are going to be attacks on Iranian oil infrastructure, which could lead to retaliation by Iran against oil infrastructure elsewhere, the price would surely sort of go through the roof. I mean, but I don't think people seriously believe that because, as I said earlier, there are too many players with too much at stake from an interruption to supplies. I mentioned Iran exports most of its crude to China. Long-term supply deals at good prices for China. China's not going to be too impressed if there's an attack on Hargeisa.
I mean, you say there's a lot of players. They're pretty silent. I mean, you don't see your Mr. Macron sitting next to you there in Paris jumping up and down saying, please don't. I mean, it seems to me like those that have a lot at stake here in terms of the potential inflationary pressures on G7 economies, or indeed China, the biggest oil importer in the world, they're all pretty quiet.
Well, yes, I suppose that's true. And in fact, I'm quite pleased that Monsieur Macron isn't jumping up and down. He jumps up and down too much to too little effect. There are other players here. I mean, I mentioned China. India. India takes about 45% of its crude imports from the Gulf region, Saudi and the other countries. It takes most of its LNG from Qatar. Now, okay, whether the Indian Prime Minister, the French Prime Minister, anybody else is silent or not, I don't think matters that much. I'm sure there are diplomatic back channels being used to try and calm the situation down, because the 10% you're talking about, Sean, would 10% would look cheap if there really was a physical attack. And I really find it hard to believe that the Israelis would strike at a if you're talking about oil infrastructure. Well, what we mean here is something significant like Hague Island or one of the refineries, at Bandar Abbas or at Hague Island. Bandar Abbas is a terminal, isn't it? Not a refinery. If that were to happen, that really raises the stakes for the global economy. And for that reason, I don't believe it's actually going to happen. Therefore, the price hike of 10% you're talking about is the sort of, I'm trying to avoid saying knee-jerk, but it's a sort of headline reaction that you might expect in a situation like this.
Peter, looking again at the fundamentals of China, how do you dissect their stimulus efforts? Because apparently there was or at least there was some expectation today of that the Chinese economic announcements that were going to be reinforced today with more. What's your analysis on what's in the stimulus box that China has announced 2 weeks ago? What is emphasized today? Your thoughts on its velocity to change the direction of travel for such a massive economy like China?
Well, if you look at Bloomberg, and thanks, Sean, you look at Bloomberg and right now, and it says China vows to hit economic goals, stop short of large stimulus. So, well, that says it all in a lot of ways. It's a wait and see approach. I think they've come back from this week off. They've seen the massive reaction in stock market pricing. You've had the CSI roll from 31 to 4,100. So, you're up 1,000 points. It's been dramatic. So I think it's a time to just inhale what's happened. And then they'll take a staged effect and see, first off, they've primed. Secondly, how much performance you're going to get out of internal combustion, and is it going to be successful? And then in turn, naturally, the next pathway forward is going to be a drip feed of larger stimulus measures, possibly to re-engage property sector, manufacturing, and get that whole infrastructure base back on track. Obviously, I haven't been there for a number of years, but obviously it's hemorrhage. And it's hemorrhage because of large property overhang as far as unsold properties. And you've got a lot of debt. So that needs to be managed. A lot of external debt is held by international banks and, of course, domestic banks internally. So all of that needs to weave its way through the market and see who, at the end, if they can get away without a crash happening. And that's the whole agenda, because they don't want that mechanism to play out. And I suppose the first part naturally is get the equity market on fire, get confidence back into it from a sentiment perspective, which has been effective. You can't argue with the numbers. I mean, it's pretty hard to say, if you haven't been long Chinese equities for the last couple of weeks, where have you been? That's pretty much the storyline, Sean.
It's certainly, as Mike Muller said on Sunday, everybody he knows in China either wish they had been long or and wish they could buy more. Again, is that a FOMO thing, or is there substantial sort of fundamentals underpinning that? I mean, the world hasn't changed that much in a week. Genevieve, I wanted to get your thoughts on the again, sort of the sense of Asia refining margins seem to be suffering quite a bit, and yet we saw Saudi Aramco just announced before the weekend a significant increase in the official selling price of their crude into Asia. Your thoughts on those two things: elevated OSPs from Saudi, which most other Gulf producers take their benchmark reference from, and the weaker demand and weaker margins in Asian refineries?
Thanks, Sean. Great question. I think what I'd like to begin with is just to recap. So Saudi OSPs had ramped up, just talking about Arab Light here, by 90 cents. And our forecast came at sort of 70 cents or thereabouts, and the market was expecting 60 to 70 as well. So a little bit higher than market expectation. And this is just for the Asian region. The other side of the flip side here is Saudi OSPs heading over towards Europe, where you dropped by nearly 50 cents, so 45 or thereabouts. So we're actually entering a period where Asian refinery runs are starting to increase, and they will peak, in Q4. We've got 1 million barrels or 950 or thereabouts KBD worth of growth between, I think it's September to November. And once more, let's get down into the details here. India provided the biggest part of that, the largest portion, around 60 to 70% of that growth. Now, part of that is because India was going through a turnaround period itself during August, September time, and it's bouncing back. Obviously going to take a lot more crude off the market. China is, of course, the part of this 900 KBD growth within Asia. But what it signals here is that there's a lot more of these medium sour barrels that are going to be imported into the Asian region for this throughput to continue. And those medium sours are likely to be Russian. I'd say Russian because of this potential disruption to Iranian flows. Could take nearly 2 million barrels a day of exports off of, like Neil said here, off of Iranian exports to China. So China will be looking to reroute what discounted barrels that it could take off the market. And of course, Russia is the next obvious, right, from a geographical standpoint. And so Saudi Arabia looking to potentially cash in on this increase in exports or price level to exports to Asia, but also trying to promote or intensify refinery runs and bring back European refiners sooner and quicker than maintenance periods may typically last based on end-use products demand within Europe. Hence why the slight price cut towards Europe. So that's the pricing action and what we see with the Saudi OSPs.
Let's go to the survey question, which sort of is triggered by my earlier question, looking at how much this $80 price, this 10+% jump in the last week, have priced in an Israeli retaliatory strike on Iran, but not on Iranian oil infrastructure. Does 10+% represent to you that it's priced in a strike on Iranian oil infrastructure or not? Oil prices jump of 10% has not on Iranian infrastructure. Agree or disagree with that? Neil, whether you agree or disagree with that, perhaps there's moments like this, as we had in the aftermath of the Russian invasion of Ukraine now 2.5 years ago, that the immediate sort of elevating of energy security that came screaming to the forefront of every political leader's sort of inbox. And we had at the forum last week in Fujairah the president of the European Storage Federation advocating that the IEA, we already had this speech planned prior to events of the last week, but he was there basically advocating that the IEA 90-day rule for members to store 90 days of import cover is no longer adequate given the geopolitical risks that have emerged in the world in recent years. So given that backdrop and current events and inventories being relatively low anyway, particularly in the US, well, in the US they are, China maybe not, but give us your thoughts on that, whether this may be a buying moment given the energy security backdrop.
Oh God, I wish I had the table open in front of me, but globally, there are massive oil stocks around the world, crude oil, not least in China, of course, where the distinction between commercial and government stocks.
But US ones are near 5-year lows, of course, the biggest oil consumer in the world.
What was the 5-year low? I mean, I'm sorry. When we talk about 5 and 10-year lows, particularly in the case of the United States, I don't think people are taking sufficient account or have noticed that the United States is now an enormous oil producer. 20 years ago, that 5 and 10-year metric had a great deal more relevance because imports were so much higher than they are now. If you tot up government stocks, government controlled stocks, if you tot up commercial stocks globally around the world, I wish I could remember the number. It's like 8 billion barrels or something like that. It's an enormous number. I do not believe there is any necessity.
Then why is oil prices jumping 10% then?
Well,
I mean, that's a lot of volatility for, if you've given the context, we have 6 million barrels of idle capacity and we have whatever billion barrels of storage that you just mentioned.
Well, because people like the President of the United States have actually used the phrase other alternatives than striking oil fields. I mean, that language, when you actually specifically mention oil fields or oil infrastructure, isn't something we've heard much of in the past. And, that specter has been raised. And we're seeing escalation between Israel and Iran with the possibility. Therefore, on the basis of that has sent oil prices higher. And as we said earlier on, I don't think most people believe that there really will be an Israeli attack on a significant piece of Iranian oil infrastructure. Because if people really did believe that, then I think the price would have gone up an awful lot higher than it has. I don't think stocks is a major issue. There is plenty of stock out there. There is plenty of spare capacity out there, which, other producers, if for the sake of that argument, Iran was less able to export than it currently is. As we've seen in historical periods in the past, the Iraqi invasion of Kuwait is a good example. Regional producers may express solidarity and they're very shocked and how horrified this situation is. But here, would you like to buy some of my barrels because I can still sell to you? There's going to be plenty of spare capacity and stock out there unless there is a cataclysmic problem in the Middle East where 20 million barrels a day of oil and, of course, LNG from Qatar can't move.
It sounds perhaps, Yaniv, that this might be a sell on the news thing, and this decline in prices we've seen today will continue, given what Neil has said there, that anybody in the right mind doesn't believe that this strike on oil infrastructure would happen, or else we'd already be at $100. We wouldn't be dropping away from 80. Your thoughts on that structure, that this could be a return to that low 70s where we were stuck at for quite some time, given the fundamentals as outlined by you earlier and Neil now?
No, I mean, I think that's very fair. Should there be no risk premium added on, then I think, yes, we could see some prices heading back down towards what they were, low 70s this time last week. But, the market has factored in and has slowly been inching up based on what's been happening in the last week and preparing itself for should there be any attack on the oil infrastructure. So that's why we've seen this slight trade flow rerouting and efficiency gain in that sense away from. So just one other metric to discuss here is the Brent front month, right? So looking at how all the key impacts were and the reactions were on a day-by-day or hourly basis against when the strikes had happened throughout this year, from April all the way through to now. And we had seen some slight rise, of course, on the previous attacks and missiles firing. But prices calmed down fairly quickly. What I would say about this most recent one is the Brent front month has had its reaction and had stayed elevated beyond, right? So we're still in this elevation period. Now, should there be, attack on Iranian infrastructure, or the Strait of Hormuz has around 13 million barrels a day of crude flowing through it and around 1 million barrels a day of products. So a real potential squeeze here now on the crudes and the products market, which could elevate prices even further. So we're in that period now, that phase where, yes, if everything does calm down back to, I guess, a sense of normalcy, or with just fundamentals playing into the part, yes, some downside, low 70s, but there is some potential for this to increase tremendously moving forward.
Peter, we saw the announcements by China recently, the stimulus again, that announced a few weeks ago, had a big impact not only in the equity markets, but also copper prices recovered back up to near $10,000 per metric ton, which of course is a big indicator for the Chinese economy moving forward, if you like. Your thoughts on the China stimulus and its sort of euphoric uplift, its sort of knock-on effects to other markets, both other commodities and other geographies in Asia?
Well, first off, yes, Sean, you're just sitting at 99.29 for copper at the moment on the LME. So it bounced strongly from that 9,000 handle, and it was well bought up in the sense tin, nickel, lead, zinc, they all had a run as well, and aluminium. So it was a fairly strong, robust rally, and it's holding at that sort of number. Where that rolls across iron ore prices, I wouldn't be surprised for that to actually move up as well. And then a lot of ways they were probably oversold to the downside. The next part, it needs consumption. You need to get the purchases of all these finished goods. It's either going to be consumption internally, and that's domestic consumption for China, and then external across the fabric of Asia and naturally into the West. And that requires people not to be tapped out on credit cards. It requires earnings to be strong for companies manufacturing goods and for an appetite out there to buy those finished products, Sean. And is that going to continue or re-engage? Consumption across, if you're looking at consumption across the US consumer, it's relatively still fairly strong from a resilience factor, but inflation hasn't gone away in a lot of ways. We've got numbers being released, but if you're looking at inflation for services and, for the likes of home insurance and all of these sort of add-on costs that the consumer feels, they're at sky-high prices. I noticed the longshoreman had struck a deal for a 6-year pay rise over a 6-year window, 63% increase in their pay packet over the next 6 years. So you can't say that they're not, if they're getting 63%, Sean, there's a lot of consumers out there that are also going to put their hand out for higher wages. And is that going to be enough to, aid China?
Well, certainly inflation isn't going away. Neil, last word to you. I wanted to get your thoughts on where the sort of the supply side is going. We've seen the again the growth forecast for the year ahead, the year we're in, ultimately deep now into this fourth quarter. At our forum last week, there was the bears were competing to be under bearing each other, if you like, that the 500,000 to 600,000 barrels a day demand growth for 2024. OPEC still calling the 2 million number, IEA somewhere half of that. Your thoughts on where we end the year now and the demand growth, what that looks like it will be?
Well, I think the IEA are closer to the truth than the OPEC Secretariat. I find it still incredible that the OPEC Secretariat is sticking to this close to 2 million barrels a day year-on-year demand growth for 2024. The IEA, in fairness, has been closer to the reality, I think. Amongst independent analysts earlier this year in the meetings we all had in London and in the Middle East, we were looking to something closer to 1.5. I think 1 million barrel a day is closer to the reality. Maybe shave it down a little bit, but not very much. On the supply side, however, there remains still plenty of planned growth in non-OPEC plus production, whether it's from the United States, Brazil, Guyana, Canada, and other countries. So absent an escalation in the Middle East, and if by some miracle there were to be a de-escalation of tension and we went back to normal, so to speak, as Genevieve was saying earlier on, the fundamentals are still relatively soft. Yes, there's demand growth, but there's also lots of non-OPEC plus supply growth, and we're sitting on lots of OPEC plus spare capacity. That is not a recipe for a strong oil market in 2025.
Well, we're going to have to wait and see what this week unveils. It's a bit like waiting for Godot for this news to land. They agree in the room here that this priced in a retaliatory strike, but not on Iranian oil infrastructure, sort of overwhelming view shared in this room. Thank you, as always, Peter McGuire, CEO of XM Australia, Neil Atkinson in Paris, former head of oil markets division at the IEA, and Genevieve Shah, vice president oil markets at Rystad Energy. Thank you all very much for your insights today. Brent crude oil trading down below $80 this morning. All the best. Thank you.
Thank you.
Thank you, Sean.
Thank
Cheers,
you.
guys.
Cheers.
Cheers.